Mr. Mark Selby. How are you?
Good, Mr. Matthew Gordon. It's been a while since we had a little nickel macro update.
Yeah, it has actually. So we obviously saw you down in South Africa. We saw you up in London. You're traveling the world. You look like you're traveling at the moment. Where are you?
I am in Timmins, Ontario for Canadian Mining Expo.
Oh, so. Do you know what? I refer to you as Mark Selby. I've forgotten. I need to refer to you now as award-winning Mark Selby.
Yes. No, we were awarded the Rising Star Award for the Abitibi area for the Canadian Mining Expo. So
right,
which is great. No, it's nice to get the recognition from the local community. So, and again speaks to the fact of just what a big mining town Timmins is when this sort of very big Canadian-wide show is hosted here. So there's literally hundreds, if not thousands, of vendors in town for this show.
Oh, really? So it's a big one. Okay. Okay.
Yeah.
Okay.
If you needed to kit out your mine, you could basically walk around the show and buy all the equipment that you would need to build it and operate it.
Okay. Well, there you go.
So,
okay.
Not quite at that point yet. So
congrats on the award, whatever that looks like. Just want to it's this kind of quick catch up. We're going to see each other in Quebec City in a couple of weeks. I think on the 19th, 20th, 21st for that new conference, the mining event, I think it's called. Very originally named. And I think it could be a good one because I think North America needs a few more sort of good quality conference event type things because there's so many little crappy ones like springing up and kind of filling people's diaries and not actually achieving much. But let's talk about the state of the market at the moment. It feels really boring at the moment. That's what it feels like to me. There's not a lot going on. People are not really rushing to market to say too much because they think it'll just get, lost in a sea of nothingness. So what's going on?
Yeah, no, it's a whole big pile of wait and see. There were some fireworks I think last time we talked was early May on the macro side, and we did see metal prices come off 8 to 10%. They were effectively playing catch up with the equities, which had already registered the fact that interest rates were up, U.S. dollar was up, therefore, mining equities needed to fall, and generally base metal prices fall before the mining equities do, but they played some catch up, at the beginning of May. What's been interesting is, across the commodities, and again, I think this is part of the reason why the bears haven't sort of been charging in there to try and see if they can knock things, another level lower, which would typically you'd see in this kind of a cycle. But again, exchange inventories for most of the commodities, including nickel, have stayed relatively low. We really haven't seen much of a buildup. In fact, over the last week or so, we started to see, LME inventories drift a little bit lower. And again, for some of the other commodities. So you've seen, we've been sort of range bound in a kind of $26,000 to $30,000 range for most of the month. And prices are now starting to tick up towards the end of that range. So, we'll see how that plays out. But it's been 4 weeks of pretty much people sitting on their hands.
Yeah, well, they have, and that's the bit I can't quite understand, because if you got cash to hand, which I think a lot of people have been kind of cashing out recently, I don't know why you're not taking advantage of some of the prices out there. I mean, we definitely have laid some kind of big bets on or doubled down on some of our projects that we're already invested in, because I think this feels cheap to me. But each their own, and everyone's got different circumstances. But I think these are the moments you wait for sure. So can you talk some more, a little bit more about? Do you know what the big thing happened this week? LME getting taken to court. Were you expecting that?
Yes, they did. Yes, the lawsuits are now coming out of the woodwork. So Elliott lined up for $450 million. Another fund is set up for another smaller amount. I know some of the bigger companies myself who aren't too happy with them as well too. So I expect over the next, now that a couple have been filed, you'll see a bunch more pile in here, and it'll be interesting to see what those damages are. Because again, it's as much as the price went up, quite a bit, and it was only, that one day was sort of one leg higher, which then came back down, but still higher than where it was before. But, a lot of people got in on that day for the squeeze up, or a few days earlier, expecting this squeeze to actually play out. And so, when you bought at this amount, you thought you were made a profit on that amount, and then 2 days later find out, oh, actually we just arbitrarily reset the price down to this number, and instead of making $15 million in 3 or 4 days, you've lost $10 million, and for some of the funds it was much bigger than that. So it'll be interesting to see sort of how that all pans out, because
Elliot,
it's crazy.
Deep pockets, right? They can afford legal bills. They can let this run. And the other thing is, as you say, if others do the same thing, if others other groups come together, like you say, and I'm sure you weren't happy about it, for sure, but this could be the beginning of the end for the LME. I mean, I said to you at the time, does something need to change? And we thought, well, yes, but it probably won't, or if it does, it won't be very much. But do you think something like this will maybe change the thought process? Do you think we could see something big happen here?
I hope so. I mean, again, more often than not, these cases end up getting settled as, okay, we'll agree to do this. We'll agree to pay you this amount. We don't, we're not going to admit any wrongdoing. So I wouldn't be surprised that this just ends up being as negotiating leverage, for these funds to see the changes, some changes happen, to make the market work better. And as well, you're at least going to cover some of my losses out of this. I might not get my full $500 million, but we can settle for $50 or $100 million, then we can drive on. So,
well, I think from my recollection of my banking days, it would be the guy who's making that trade is going to trying to protect his job, because he's the one I'm looking at. If I'm his boss, I'm looking at him and going, "You put us in this position. That you must have had a backup." Nope. Let's go to court.
Yeah.
Yeah.
Your P&L. Yeah. It's like, we're not going to adjust your P&L for that.
No
problem.
Let's talk about NPI price dropping as expected.
Yeah. So I mean, that's at the beginning of the year, made it very clear that this was going to be the year where you were going to see some massive blowouts in terms of that NPI discount. And again, they're even more large now because LME prices have gone up higher than I had initially expected. And so, the key there is Indonesian production's ramping up. That product can only get sold into China, and so as a result, the discount has to widen out enough to squeeze NPI production in China, to make room in that market. What's interesting is that really hasn't happened yet. Again, with the elevated prices being elevated to where they were, that's kept things relatively tight. We haven't seen, Philippine ore prices have also stayed up relatively high. I would expect that whole chain to really collapse, and NPI production to really collapse. If we end up with a big oversupply, and we haven't reached that point yet, I still think that is coming over the next few months here, and that will be the sort of capitulation point for NPI production to come off. But again, the key thing to remember there is it has to balance itself, and that's the source of where the oversupply is coming from, which will again keep the overall market relatively balanced as well. And again, later this year, once the Ford Explorer starts ramping up and the big U.S. cars come, that's going to be a lot more nickel demand for batteries going forward into the marketplace. And that's always been the time period where I expect to see prices sort of pull up higher from there. So
right, and what's your expectation around Chinese sulfate prices then?
Yeah, so what has been a surprise, and again, sort of should have thought through it a little bit is. So again, at the beginning of the year, thought NPI prices were going to have this big discount that would provide a huge amount of financial incentive for all of the NPI producers. And as I've said, the beginning of this year, within 12 to 18 months, you're going to see all of the major NPI producers have plans to produce 30 to 50% of their output as matte, and that has been happening. But because the NPI discount is so large, and if you can still sell your matte at a premium to that product, but still a big discount to where the LME price is, you're kind of good to do that. right? In terms of this whole source of feed that, again, needs to all kind of get balanced out within China effectively, because there's not capacity elsewhere in the world to process that mat, that's out there. So what's happened with the lockdowns in China really sort of causing some slowdown in the whole EV supply chain, and people not in a rush to buy sulfate like they were earlier in the year. You've seen all of the prices for the input materials into sulfate drop from 95% payable, where the sulfate was then trading at a premium, to basically sulfate also trading at a discount to the LME price. And the price of that feeds, again, maintaining some sort of profit margin, has dropped into the mid 70% range. So again, expect that to persist through the summer. Once the EV chain starts to sort of re-ramp up again, and the lockdowns in China have come off to some extent. So that situation should correct itself in the fall. And again, the Chinese NPI shutdown should start kicking in over the summer as well, which will also help sort of balance that whole system out.
Okay, and something which obviously every single company wants to come on and blame for their woes is the Russia-Ukraine situation. Now, given Russia's 25% of ex-China production around the world, any kind of sanctions or any kind of tariffs or any kind of change in the flow of that nickel will have a big impact on the market, not in terms of volume, but in terms of pricing. So we don't seem to have seen too much disruption there yet.
No, it's continued to flow. Again, that nickel is also produced alongside a whole boatload of palladium. Norilsk is the world's largest palladium producer, which we still need for internal combustion cars, for catalytic converters. So I don't, unless things get really, really nasty, Norilsk, the output from Norilsk will be the last sort of production to be sanctioned by the West. They'll avoid doing that as much as possible. That being said, what the impact that we are seeing, and it continues to persist, is, as Norilsk nickel is a big chunk of Western world production, it's also a big chunk of 99.8% or better nickel purity products. And so for all of those, because people are, that is a supply risk, people are holding on to more inventory of that product. And the flow of it, because it's been difficult to ship stuff out of Russia and so forth, is you've seen premiums for all of those products spike significantly. If you're Vale or Glencore or any of the other existing pure nickel producers, they've been just printing money over the last 2-3 weeks, because you've seen premiums go up by 5 to 10x. Where they were before. So they're trading at a few $100s a ton over the LME price. They ballooned out to $2,000 a ton plus over that price. Again, those will come down as sort of the market quiets down and so forth. But that's kind of been one of the lasting impacts, which has been super beneficial to the existing producers.
Okay, do you know who needs palladium at the moment? Holly.
What's that?
Holly needs palladium right now. She had her catalytic converter stolen from her car at the weekend. So there you go.
Welcome to high metal prices. There
exactly. It's your fault, Mark. So, well, and what else should we be looking at? Because, like I say, it kind of feels kind of sort of boring. I see holding pattern, waiting phase, which probably suits some more than others at the market at the moment. So, what should we be looking at, and what's your expectation of how this kind of rolls out? I have this theory about Joe Biden dropping something quite nice and into the market pre-midterm elections, which will help with sentiment a little bit. But what else is it going to take?
Yeah, no, I think, so first off, in terms of positioning, I think these are the times where, again, if your conviction on the medium to long-term story is there, something we've said all along, then when again, our stock and most of the nickel developer stocks are all off 1/3 from where they were back in the beginning of March, is to start to pick away, during this time period. And again, if there's if there's some really bad news, the shorts will try and come in and knock prices down a level lower, which again just gives you another buying opportunity. But there's no guarantee that that's going to happen, and they're going to step in. And if prices start to run, the last thing you want to do is really try and catch a stock that's already starting to move higher at this point in time. So slowly pick away. And in terms of, catalysts, we obviously are going to go through a lot higher interest rates as they try and squeeze, the extra inflationary pressure out of the market. But politically, as you said, Joe Biden, he's got to do something. He's got to try and find some rabbits here. Otherwise the Democrats are going to get wiped out in the midterm. So yeah, guaranteed there's going to be some kind of goodies there to help the U.S. market and consumer confidence. People feel good there. In China, Xi Jinping basically, has locked up huge portions of the population as prisoners in their house for, several weeks or more during these COVID lockdowns. So he's got a bunch of his populace is pretty grumpy. Again, the last thing they want is to see their house prices fall or, other economic catastrophe happen. So again, I think the Chinese are going to, overemphasize stimulus, in order to keep the broader economy going. And again, in Europe, we've had all of this energy squeeze announcements and so forth and so on. And so again, too, I think, the politicians will want to try and offset some of the gloom and doom from Ukraine. So I think there will be some amount of offsetting stimulus. And again, the fundamentals in the EV market are not going away. So from the battery metals perspective, as that, as the growth, sort of re-ramps up again, and it will, subject to broader supply chain constraints in the EV industry around chips, that should, start to take the battery metal prices or the not lithium prices higher, by the end of the year.
Here's a question. It's a kind of, I guess, economic question, but you've got to have a view as a CEO about how to kind of play the markets going forward and where you kind of sit in that mix is right. Okay. So we've talked over the past few weeks and months about supply chain issues because of COVID. We've got and monetary policy changing because of printing money and pumping it into the marketplace. We've seen, obviously, with Russia, Ukraine, we've seen sanctions come to bear, and in a sense, in this sort of tightening economy, this deglobalization, which typically, with all of those things moving on, a conversation around recession or stagflation or however the heck you want to frame it, and enters the narrative, right? And we'd like to look at behavioral purchasing and behavioral psychology in giving a sense of what the future holds, right? And I'm just wondering how the natural resource space as a whole fits in with a kind of that new dynamic where people are perhaps less focused on things like NFTs and Bitcoins and, temporary things, products which have a shelf life of less than 3 years, and maybe they can focus on a few more important things, which, they need rather than want. And for natural resource companies, obviously, without mining, without oil and gas, it's very hard to make the things which we all need. Does it kind of make that industry not immune, but less affected to these inflationary, stagflation scenarios or inflationary scenarios? Or is it a cross that you're going to have to bear as well? Do you know what I mean? Because we've seen the tech space get absolutely beaten up. They are not immune. Discretionary spend really matters with them. But I'm talking about, the industry, like nickel is a good example, copper is a good example of commodities which are needed to build the things that people need, not want. So therefore, is there a kind of immunity in some way? I know there's additional costs, but margins will hopefully not be affected. So, can you operate in that environment?
Yeah. So I would say sort of three things to that. So first off, if you go back to the late 90s, when the internet boom was on and, allthings.com were worth billions, those stinky old people who actually touch physical things and make physical things, the valuations on those stocks completely tanked, and then come 2000, 2001, then it was the mining, the resource stocks that outperformed for a good 8 or 9 years before they got too frothy, and things rolled over again at the other part of that decade. So I think we're just at the beginning of one of these big sectoral switches between sort of tech and resources, which is there. So I think, to me, that's a good headwind, for the next 5-ish plus years. Number two is, again, in terms of investment cycles, typically, what you would have seen by this point, with inflation up, interest rates up, is that we would also have been in the midst of a big investment boom in developing new mines in the resource space. But, again, despite again, companies in the 2010s were very focused on free cash flow discipline because they had done so badly back in the last development cycle in 2011-12. But we really haven't even had a development cycle yet. And you've got a decade of copper growth, a decade of nickel growth, a decade of a lot of commodities that really need that new chunk of capacity to come online. And we still really haven't even started getting that, into the marketplace yet. So again, I think that's going to be constructive for commodities over the next 3 or 4 years. In terms of inflation, we will not be immune, but this is one of those places where it is good to be cognizant from a cost perspective. That inflation will play out, in different ways. So, for example, in a place that was already at 104% capacity, like say Western Australia, in terms of labor, any incremental activity is just going to, drive up labor costs even more. If you're in a place where most of the energy is thermally produced, again, high coal, high oil prices, are going to really push up power costs relative to, what we've got the benefit of here in Ontario is, an energy base that's mostly nuclear and hydro. And so we'll be shielded to some extent and hedged, from some of these cost pressures, and again, if you're building a place, what you don't, the contrast would be building a mining project in a place that you've got all the infrastructure in place. It's easy and relatively cheap to move people and materials in, versus remote location in a jurisdiction that is already at full labor capacity, full everything capacity. And, the price of everything in those regions is going to go up 50%, and the price in these regions might go up 10 or 15%, and that arb opportunity there is I think something to pay attention to as given those two big macro themes I see there, where to pick your winners in between that in a high inflation and, environment that I think will persist for the next 3 or 4 years as well.
Let's leave it there. We're going to see each other in a couple of weeks in Quebec. We're going to talk companies. We're going to, we'll dance our way around it, but we'll ask the questions about the different players out there. We need all of the above, and it's a question of what do we need to look at as investors? What should we be avoiding as investors? Because although we need all of the above, some of these companies will fall over, and I don't really want to be holding the baby when that happens. So I'm looking forward to that.
Yeah, no, we haven't really done a big company dive. So again, get people to send in, their companies that they want questions on, and we'll try and work our way through it to an extended in-person session in Quebec.
Brilliant. Okay, Mark, appreciate your time today. Thanks, mate.
Thank you, sir.